Hey guys, Philip at Trade Genius. Welcome to another episode. Bob and Phil here. We're going to talk about how the government is messing up our portfolios, whether that's cryptos or stocks. I'm also going to give you guys a little bit of an update from yesterday's video on FTX and what's going on. So without further ado, let's dive into this video.
Trade Genius.
All right, guys, before we dig into this video, I just want to give you a quick update on the FTX situation from yesterday's video. If you're on the FTX.US exchange, I would encourage you to take your funds out because the exchange said they're probably going to halt trading there and you will be able to get your funds out. It's still liquid, so you're good there. The FTX.com users, however, we're still trying to figure out all the details on that. There's been some more updates, which we'll cover maybe in tomorrow's video, but things are still coming out. So we want to make sure we have kind of like a good game plan of what's going on there before we give you more updates on that. So that being said, pretty good day in the markets, eh, Bob?
Yeah, I mean, it's pretty funny. We picked a topic that I think is probably bearish, but you have these types of markets when you have when you're in bear market, especially when people get hopium around that the Fed's going to go ahead and somehow pivot. The one thing that they don't understand when they talk about pivoting is usually that's when you get your biggest sell-off. So I think today was some sort of a relief bounce, or it was a big money trying to create a liquidity event for them to continue to exit the markets. Because when you're looking at what I would call, it's called basically the free money rate, which is, the 10-year is basically they call it the risk-free rate. Don't argue with me about what's risk-free, but that is as risk-free as you get in the world is the U.S. Treasury 10-year rate. Is that thing gets pushed up from essentially 0 to 4%, pushing up, and probably will end up probably close to 5% when it's all said and done. Is that it makes all the other calculations for risk fill a higher number. So, and for example, and I'll get into the charts here in a second if you'll indulge a bit of a monologue here, is that if I'm a real estate investor and I'm getting a 5% yield on my property, okay, it's one thing if I was getting a 5% yield on my property when my cost of capital is at 1%. It's a far other thing to try to get 5% on your yield on your real estate when the 10 years at 5%, because nobody's going to buy your property, okay? Because they might as well just stick it in a 10-year. So a lot of what's happened here in real estate, and we'll get into some of these other games too, is that people, what they do is they borrowed short, which means they borrowed short duration loans. Now I'm not talking about, you got your mortgage, you got your 30-year, you're good to go, you got a 2.5% mortgage rate for the rest of your life. I'll explain why that's a problem later. Is that, but most people borrowed short. They borrowed 1 year, 3-year, 5-year notes, and all those notes now are going to get refinanced at a higher rate, which means you recalculate the value of these properties. So we saw it first with bonds, right? I own TLT as a hedge for my portfolio. Well, TLT's been dropping like a stone all year because its price is getting revalued against the yield that is going up in a continuous fashion. And so the bonds were unattractive at lower rates. People coming in later now on bonds are getting very attractive rates to hold and take less risk. They're going out less on the risk curve, Phil, which means they're not going to be speculating in real estate and in these crypto yield schemes that seem to be blowing up all over the place and in the stock market. And then some of the stocks I'm going to show you is that they existed primarily because they're in a low and falling yield environment, and they're not going to survive in a rising yield environment because their customers are getting pinched, number one, and number two, their reason for being disappears, is that they just are going to lose a market. So with that, I just wanted to give people a backdrop on that 5%. Look, even if there's no more inflation and they don't raise any more and they don't cut any more, if we're at 5% 10-year a year from now, the stock market and the economy are in big trouble. So it's not like, okay, they stopped, everything's great again. Basically, the floodwaters came into your basement, but they're not leaving. you consider that a good thing or a bad thing? I would think it's a bad thing, right? So,
Yeah.
so that's what we're faced with, and that's kind of the theme for today. But today's market was, I mean, up 5.5% in the S&P. If you're long, I was long, mostly long, a little bit short. So my longs did great and my shorts didn't. So it was, but overall, it was a fantastic day if you own risk assets.
So Bob, take us into some of the charts you have prepped for this video.
Yeah, first thing I want to show you is the sector returns.
Okay.
This kind of a play into what we're talking about. So if you look at the bottom there, and you got real estate, you got tech, and you got financials are on the bottom half of that curve because they rely on cheap interest rates to cheap financing to basically grease the skids. And then you have on the other side, energy. We talked about that forever. Energy's done great. Healthcare is basically a low beta environment, and they generate a lot of cash, both those businesses. So they weren't nearly as affected by higher interest rates. And so I just want to kind of throw that out at you. And I don't think this chart doesn't change for the next 6 months, Phil. It's still going to be it's going to be energy, commodities, and healthcare. And on the bottom side, it's going to be basically tech, finance, and consumer spending, and real estate is going to be on the bottom side. Next chart I'm going to show you. So Airbnb, again, forget the short squeeze for today. Their business model relies on basically, everybody and their brother owning, all these properties, and they put them out on the rental market. They didn't put them out in the long-term rental market. They put them out in the short-term rental market.
Right.
And a lot of these people paid premiums to own these properties, and they financed them at very low interest rates, and they daisy chain these properties. So what I mean by that is, if I bought one property and it went up 50%, I use some of that collateral as a refi to down payment for my next property. Basically, they're rehypothecating their own asset base. And what I mean by rehypothecating is that they're basically building a Ponzi on top of each other. And then once that collateral starts to unwind, they may get called on putting more money into these properties, which they won't have. At the same time, the consumer, as you can tell, look at a credit card, the consumer is not going to be traveling at the same rate, or they're not going to pay these premiums. And you're already starting to see the bloom coming off the rose in some of these urban areas in terms of what rents people are getting. The fees are really high, and people are starting to rebel against the Airbnb model. So at some point here, probably next 6 to 9 months, you're looking at Airbnb down in the and you can read that eye chart better than I can, Phil, but I think that's down around $60.
Yep. Yep.
And so I have a long-term short on Airbnb, and I think I'm going to be vindicated and validated by that one. So if you want to flip the next chart up, Phil. Tesla is another really interesting animal. So in the car market, you have requirement for financing. And I'm picking on Tesla because they're the biggest, and they're also the most overvalued car company that ever existed in the history of man. I think they're still more valuable than all the other car companies put together. And their intrinsic value on a cash flow basis is down around $23 a share. Okay, so Tesla, the bloom is starting to come off that rose. And actually yesterday, before the big squeeze, they hit the target here to actually start the downward leg. Now, they had a $10 move today. In the past, that would have been a $30 move on Tesla. Okay, they're going to keep rolling down, Phil. And the measured move puts them at negative. So I don't think they're going to get to negative, but they're going to be cut in half pretty far. And I can't read where I put my circle here on the fibs.
That level you have down there, the 236 fib, I think is 106.18, $106.18.
Yeah, so that's the next move down for Tesla. But make no mistake, when we come out of this recession, you're going to see Tesla likely below $50. Okay. Remember, people can't afford a $70,000, $80,000 car at current interest rates for car loans. And here's the other thing that we have to keep in mind. Carvana has been kind of keeping the used car market values higher because they kind of overpay. And if they liquidate Carvana, it's going to dump a whole lot of used cars out on the market, and people are going to reprice that whole market down, and that puts pressure on all car companies, including Tesla. So Tesla is in a heap of trouble long term. And then again, Elon Musk uses Tesla as a funding source for his other ventures, and as they need cash, he's going to be selling down until he's constrained by his capital or collateral from the banks in terms of what he pledged for Twitter. Now, ultimately, I think Twitter is going to be a great deal for him, but it may suck cash, and some of his other ventures may suck cash, and that's also going to put pressure on Tesla as well, Phil. So I wanted to talk about those two. There's a couple other areas too that to bear in mind as you look at kind of like Upstart. We're going to get a gift here. Upstart's up like 20% today. We're going to short that one pretty soon. Okay, that a company like that and a firm, these people lend to less than qualified borrowers. That thing's going to go to zero as well. So, these sometimes when you get these short squeezes like we had today, these are gifts. And probably sometime early next week, there'll be good opportunities to put puts on those.
Awesome. And one thing, so you guys have seen where Bob's really laid out some pretty fundamental problems with these companies. And that's on top of what the government's doing. And we're seeing that through the yields. So what I wanted to show you guys was how the yields not only are affecting these stocks that Bob's showing you. So it's like a double whammy because not only do they have the fundamental problems, but they also have this problem, which is the yields are rising. This is the 2-year yield. Those candles there that you guys see with the red or the green band under it, that's a extremely strong trend on the 2-year yield, okay? And that's a daily chart of that. And what I have overlaid on that is a price of Bitcoin. That's that golden line. So you can see where when the yield started to tick up toward the end of 2021, where Bitcoin, so about a year ago, Bitcoin had topped out on its second peak, more or less. Yields were cranking up just a few tenths of a percent, and it was already starting to put pressure on things, on assets. Okay, and this goes for Airbnb and Tesla as well. But we wanted to show you guys how the government yields are just killing these asset prices. So then it starts to crank up, right? And look at what we're doing. We topped out here at over 5% on the 2-year, right? That's insanity, right, Bob, on the 2-year? So anyway, I wanted to show you guys that this is the symptom of the problem here, and it's crushing. If you're long these portfolios, or if your portfolio is long these assets, you have to keep an eye on the yields. And the other side of that is where we get to where these yields turn. And I wanted to show you the next chart, which is. This is showing you, if you look there to the left, around the turn of 2019, going into 2019, you'll notice our range trader went from green to red, and it flipped there. And that was telling you that the trend was rolling over on yields. And we are of the mind that you're going to see a similar thing here as we kind of rotate out of this high yield environment. Not only the yields turn down, but we'll also see these assets bottom out. And probably, my thought is anyway, that's going to coincide with the end of the bear market. So you want to keep an eye on this. If you guys have our indicator package, obviously you can slap this onto a 2-year chart weekly, put the range trader on it. And when that flips, then we probably have the green light for the end of the bear market and start legging into this bull market, which coincides with Bitcoin's having, this 4-year cycle that Bitcoin has. If you zoom out on those charts, it often coincides with the equity cycles too. So, and Bitcoin's supply diminishes, so it creates more of a squeeze on the price of Bitcoin, and that's why we get these higher and higher cycle peaks as time goes on. So, so basically you got fundamentals hurting stocks like Bob's showing you, and you also have the yields, which are really crushing risk on assets. And that's really what we wanted to show you guys today, how things are affecting on the macro basis. So that's going to probably do it for this video. Bob, you have anything else you want to add to that?
Yeah, the only thing, and maybe we'll talk about it, squeeze it into maybe our shows tomorrow or Saturday, but there's a really cool chart that talks about whether the stock market's over and undervalued, and it's called the Rule of 20. And I think what I'll do, I'll tease you guys and I'll show that to you tomorrow. Maybe you can give me 5 minutes of your crypto time tomorrow, Phil, and I'll show you a really cool idea here called the Rule of 20. I didn't invent it, but I think it kind of helps you understand whether or not you should be adding to or reducing your risk assets. And with that, I'll leave it, Phil. And like I said, enjoy today. Tomorrow we may get a follow through. It's really weird. The bond market's closed tomorrow for Veterans Day. And for those Marines out there, happy birthday. It's our birthday of 247th year of the Marine Corps. And so thank you for your service. And then also bond market's closed tomorrow. That may have affected how aggressive things were today. Maybe a lot of margin desk activity forcing people out of short positions ahead of the banks being closed tomorrow. So if we get a follow on tomorrow, Phil, then I think we're going to go towards your the resistance areas. You can talk about those tomorrow in the market. But if we pull back, then today was one of those like 2008 events where you get these one day wonders, and everybody leans into those, and then they take it away from you the next day. But I'd be watching. This happened, I think, a month or so ago, Phil, or 2 months ago, when we had a big day up, and then the next day was down, and everybody started panicking that. And you said, "Hey, if we close above the halfway mark of today, tomorrow, then I think the bull's going to continue in the next week." And then check Phil. You got to get Phil's newsletter. Talk about liquidity, because if liquidity didn't come into the market, then I think we have opportunities to start looking on the short side again. If liquidity came in, could be Katie Bartador. The fireworks are beginning here for the next couple of weeks.
Right. And I think on Saturday we can probably take a quick look at the chart, because we'll have the Friday, all of the week up until Friday's updates, and we can see if maybe some of that stuff is signaling for a red week next week. So we'll see how that plays out. Before I forget, before we go, anything crypto related you guys want to have reviewed on the charts, as usual, just put them down in the comments. I'll flip through the charts real quick, and then we'll kind of dig into like where we are with FTX and all this other stuff in the crypto carnage, and talk about levels that we can expect to be in play as we kind of get into this, what I would call probably the deep part of the crypto winter that we're in. And it's, again, part of the cycle. So that's it for today. Appreciate you guys watching us. Please hit like and subscribe. It really helps out the channel. And thanks for those stocks, Bob. Appreciate that.
No problem. Thanks a lot.
Bye-bye.
Trade Genius.